I think, unfortunately, I'm really expecting the US dollar to remain strong through the rest of the year. That's the outcome, really, of the US economy's outperformance versus the rest of the world, something that we very much expect to happen over the coming year and beyond, frankly. And it's also clearly an impact or an outcome of higher geopolitical tensions, which tariffs and the situation in Russia-Ukraine is stoking. So I'm afraid for the rest of the world economy, we're going to have to stick with a much stronger dollar, I'm afraid.
And it's really the story that ties into the U.S. sort of exceptional growth story as well. I mean, if I look at, markets like South Korea, it is expected to grow by 1.5%. I mean, that is the lowest in over, 2 decades or so, if you take out all the crisis years. So will the tariff war strengthen the U.S. growth story, and does it really hammer more of the EM markets?
So I'm really expecting that tariffs will be a negative for the US economy. Clearly, they're going to push up prices, and that's going to impact the real incomes of consumers, really the backbone of the US economy. However, that does come against a broader backdrop in which US productivity performance is simply exceptional in the world at the moment. Productivity is growing so much faster than anywhere else. That's largely due to tech investment. It's due to a lot of labor market churn. That productivity growth means strong real incomes, and consumer balance sheets are in really strong shape in the US.
And yet the consumer, as you mentioned, is actually not very strong at all. And if you've got these tariffs as well, which could raise the cost of living crisis even further, I'm wondering what that inflationary impact then means for the Fed if you also throw in on top of that the potential incoming fiscal stimulus, which also could be inflationary.
It's no doubt that it's a very, very tricky environment for the Fed to think about. You might have a slight pickup in inflation if we do see more extreme tariffs imposed, particularly on Canada and Mexico, where clearly the US gets a lot of its energy and food. Those prices rising will really impact people at the bottom end of the income distribution in the US, who are already, as you're saying, feeling somewhat weak. At the same time, though, whilst you get that impact on prices, the negative impact on growth will come later, and that will bring inflation back down, balance that against the fiscal objective, and it all adds up to the Fed probably staying on hold, we think, at least until December, whilst they figure out exactly what the net impact of all these opposing forces will be.
So their hands are tied until the end of the year, you think?
I think certainly they'll be very cautious about going one way or the other, delivering a big market signal when there's so much yet to be determined. We think there's a big fiscal package coming in the US. There's going to be a lot of debate, a lot of horse trading within Congress. Who knows what that'll actually look like and when it will be implemented, crucially.
Do you think that from a political standpoint, I mean, Trump has certainly not been one to hold back on his feelings about the Fed, that if the Fed does not cut rates between now and December, that there's going to be quite a lot of political pressure piled on?
I'm sure there'll be a lot of political pressure on the Fed, certainly from Trump and his administration. But in some senses, I think the idea that it will really influence what they do and the direction that they take is a little bit overblown. It might do on a given rate decision where it's already hanging in the balance. There may be a little bit more pressure to go one way or the other. But fundamentally, they've got an inflation target. That's what they'll be judged on in the end. They'll do what they think is necessary to achieve that.